It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
Hello out there, welcome to a new week and a new edition of Macro Mondays. My name is Mikkel Rosenvold, and with me as usual I have you, Andreas. Welcome.
Hi, Mikkel.
Has it been a good weekend after a tumultuous week last week?
Sure.
A little break from things.
Yeah, much needed break.
Yeah. Absolutely. We have a great show today, Andreas. We're going to dive into the update of our macro regime model, look a little bit more into the liquidity question, and ask the question, is it time to start buying again and look at some certain sectors? So hopefully a very, very actionable episode this week. We're looking to do that and to explain some of the stuff that we're looking on here at Steno Research. As usual, just a small reminder here. First of all, remember that our trade ideas might be...
sometimes may be good, sometimes may be shit.
Absolutely, that's important to remember. Secondly, remember you can find all the content at stenoresearch.com. We do a huge number of weekly articles, very much based on a number of these models that we show you today. We'll be covering a lot of things this week. We'll get back to that as well. Andreas, I just want to start with what's going on in Ukraine, because things started to heat up over last week, and we didn't really cover it last week because everything else that was going on.
Yeah, so Mikkel... let me ask you, I mean, we bought nat gas last week in anticipation of a rebound, basically, and also partially as a consequence of what could be upcoming in Europe, as we know that the deal surrounding the so-called Brotherhood pipeline will end by the end of this year. But given that Ukraine is now actively seeking to gain territory in Russia, it seems, it could be that this nat gas situation spirals out of control already before New Year's. That's at least one of the things I have on my radar. So, I mean, Mikkel, fill us in a little bit on what's ongoing. Why is Ukraine suddenly on the offensive?
Yeah, it was a big surprise that Ukraine has launched what's been called the Kursk offensive. Basically, it's the purple area you see here around the city of Sucha. So this is not a huge offensive. Initially, I thought this was more of a raid. It's obviously into Russian territory, so it's not part of the occupied areas that they're trying to take back. This is into Russian territory. Initially, my assessment was that this was some kind of hit-and-run style attack. They were probably going to hit some gas stations, not gas stations like that, but gas metering stations. They were going to hit the railway going north-south, just outside of Sucha. But it seems like the Ukrainians have invested more forces into this than initially reported. They are trying to hold this, you could call it a bridgehead or a salient. And now it's turning into more of a potential bargaining chip. So that's my assessment right now, that the Ukrainians are actually trying to hold on to this territory if they can. They're not just trying to get in there, destroy a bunch of stuff, and then get out again. Why are they doing this? Well, this is not going to change anything in the grand scheme of the war, militarily speaking. I mean, this is a relatively small incursion. Not too many Russians live there. But the looks of this is very, very poor for Vladimir Putin. And this is a huge internal issue in Russia. It's a huge embarrassment for the Russian regime and the Russian army. And finally, my prediction is still that we are getting closer to negotiations between Ukraine and Russia. And to hold even just a small part of Russian territory, it's an excellent bargaining chip, because that means that Ukraine enters the negotiation room with something that Russia wants as well, rather than simply entering the negotiation room asking for peace. So that's probably what we're looking at here. There are a lot of risks connected to this operation. Obviously, the Ukraine are tying up a lot of forces here, but obviously Russia has to divert a lot of resources into this. So yeah, very interesting situation.
So Mikkel, we've seen, for example, military equipment from European countries and the US used in this offensive.
Yeah.
Is there any merit to the view that this is NATO entering Russian territory?
No, no. Not really. In the same line of logic, you could argue that the U.S. was fighting the Soviet Union directly in Vietnam back in the days. Not really. These are NATO weapons, but it's very customary for big powers to supply weapons to their proxies. So no, I wouldn't fear that. We've also seen the Russians have obviously are trying to respond militarily and kick out the Ukrainians, but there's been no talk of them escalating this war over this. This is a crisis for Russia, but it's more than anything, it's a huge embarrassment for them, especially if Ukraine can advance further to the major city of Kursk. I don't think that's realistic, but the Russians are obviously reacting heavily to this.
Yeah, we've seen some videos on social media claiming that the Ukrainians were already in Kursk, but they were obviously fake. Just to clarify,
they were, but that's obviously the Kursk has a lot of significant of historical and symbolic significance for Russia as well. They fought a huge battle with the Germans back in World War II here.
Yeah.
So it is
and won.
Yeah, absolutely, and it is a very big, embarrassment for Putin. But potentially a big PR victory for Ukraine more than anything else. They might take a couple thousand Russian prisoners of war. They might grab some territory, but this is a PR win, which is also encouraging all their Western supporters, basically.
But Mikkel, to me, in layman terms, it seems like this war is following some sort of sinus curve, right? We're basically moving back and forth in terms of momentum, etc. How do you view the momentum right now?
We were. I made this curve a couple of months ago, or in the beginning of the year, that the initiative was basically shifting like a pendulum. Yeah. That pattern changed early this year because the Russians has had more or less permanently taken the initiative in the war throughout 2024. That's why I made this pendulum sort of flatline towards New Year's and over New Year's. And this is obviously changing that. And that's why this is significant as well, that the Russians are still attacking throughout the Donbass. They're making very limited, very disappointing gains. But now Ukraine has managed somehow to take the initiative, at least on this front. And that is very significant and is very, very useful for Vladimir Zelensky as he hopes to bolster the Western support for Ukraine. So this is more a political victory than a military one.
In relation to the natural gas trade and to the energy trade overall, it's important to note that this Brotherhood pipeline through Ukraine still supplies the European Union with nat gas.
Yes.
It's not massive in size, but it's not irrelevant either. We're talking a pretty decently sized single digit as a percent of the total supply in the Eurozone. And ultimately, my best guess is that come next year, that pipeline will not be in operation. The question is whether we should expect that pipeline to cease operations already this year. And given what's ongoing right now, I mean, let's see. But it's certainly something that fuels, in lack of better words, the nat gas trade right now, and we're roughly 10% in the money on it. So I think the risk reward of being long nat gas also some sort of, you can almost call it a war hedge here is pretty decent.
Absolutely.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
So, Andreas, enough about Ukraine. Let's get back to macro. I just want to start out with one really interesting chart that you had in your big editorial here on Sunday. It's this one: bullish versus bearish advices. Maybe just start by telling us what do we see in this chart?
So, I mean, on a running basis, this time series basically depicts the amount of advisors saying that they're telling their clients to be bullish or bearish on the overall market development. And we've seen a few major drawdowns in the number of bullish advisors over the past year. We saw that during the sell-off from, say, August until October last year. We saw it during the April sell-off this year, very driven by tax seasonality around liquidity. And then we've seen it again through July. and into August. So it's a very typical pattern. Every time the market sells off, advisors call their clients and tell them to sell.
Yeah.
It would have been nice to know it up front, right? But the point here is that it's been a pretty decent signal every time we've had such a landslide in the number of bullish advisors to basically bet against it. We leaned into risk assets through last week after that meltdown last Monday. Those of you who watched our flash update last Wednesday will know that we bought into Taiwan. We also bought into European banks, etc. So it's been a very good rebound trade already. And I think there's more to it. We can get back to why. But I always like to bet against the prevailing consensus among the advisors. They typically react rather than look forward.
Absolutely. So this is very much a question of timing. That's going to relate to our main question this week of, is it time to buy again? Before we get to that, Andreas, or perhaps to prime that discussion a little bit, I just want to take a look at our updated macro regime. We've talked about that in past programs here. And essentially, this maps out our understanding of the current macro landscape. This is updated monthly, so this is relatively short term as much of our thinking. But essentially, we're moving from gung-ho territory, perhaps, and into QE-like. We've been dancing a little bit between those regimes over past months. Why are we at QE-like right now?
So let me say a few things around the methodology behind this. First of all, we're actually transforming this into a daily signal. The volatility that we saw through July was sort of a testimony to the need for daily signals on how to handle the ups and downs in risk assets. So I actually think it was a very correct regime up until the release of the CPI report in July, this gung-ho regime. Liquidity was doing okay. Inflation dropped. And growth was doing okay until the last couple of weeks of July. The sell-off in tech stocks and other high beta assets after that very soft CPI report in July was a big surprise to me. We were wrong-footed by that. I have to admit that. The interesting thing is that when you look at it historically, you would argue that a drop in inflation is good news for risk assets mostly. The point here is that through the latter part of July, especially as Bank of Japan started withdrawing future liquidity through their communication around their quantitative easing program, we basically moved from positive disinflation to fears of an outright balance sheet contraction, deflation, falling prices. I mean, we can record a podcast or a show on why markets always fear deflation and why economic agents fear deflation. But as soon as you get that narrative up and running, you better run for the hills. So that was also why we said last week, what you need to watch from here is whether inflation expectations start to stabilize and whether the liquidity outlook stabilizes after what Bank of Japan did. And I'm currently of the view that we're starting to see green shoots in inflation expectations in an upwards direction. You actually want them to rise here. We're starting to see green shoots in the liquidity space. And therefore, I'm not overly worried about the sell-off risk for the remainder of this month. But you need to stay vigilant here. And I think it's a good idea to be a little bit active around your risk management in this kind of environment. But the signs are pretty much there in terms of buying the dip. We can show a few charts on why, Mikkel.
Absolutely. So let's dive a little bit more into liquidity and inflation also. Just a little bit from the Hobbit. If we are in QE territory. Well, you wrote an editorial on liquidity on top of the continued decrease in the overnight reverse repo facility.
Yeah.
So liquidity is improved in recent days. Why is that significant?
So this chart is a basically a picture that is very telling around liquidity right now, because we saw through parts of July and also the early innings of August, a spike on an average level between the SOFR rate and the Fed funds rate. And why is that important? Well, it tells you that there is a scarcity of dollar reserves available for the participating banks in the US financial system. When SOFR spikes relative to the Fed funds rate, the policy rate, it is a sign that we're very close to what I call sort of lower pain thresholds for the amount of liquidity available for the banking system. And it is therefore of utmost relevance that we get a liquidity increase here, because otherwise we'll continue to see stress in money markets and we'll continue to see spillovers to risk assets from time to time. Last week, I started fearing that the overnight reverse repo facility would spike, which would withdraw liquidity from the financial system, as the market started pricing in panic rate cuts from the Federal Reserve. And the worst thing the Federal Reserve could do at the time was to cut rates in a panic move, because that would have allowed markets to keep pricing in a lot of rate cuts very short term. And if you're a, say, money market fund or another agent with access to the overnight reverse repo facility, you consider whether the yield on the facility, the repo facility at the Fed, or say the 1 week, 2 week, 3 week T-bill yields better. And when you price in a lot of emergency rate cuts, as we did last Monday, all of a sudden this reverse repo facility looks very compelling relative to T-bills. And as soon as the market calmed down, and I think it was very wise of the Fed not to try and confirm these rate cuts, we actually got a drop in the overnight reverse repo facility and liquidity additions to the system again. So I'm of the view that should we get some hiccups again here, the Fed will address them via liquidity additions, not via emergency rate cuts. That would be the worst possible solution, since it would create a lot of issues around liquidity. So the point here is that we're starting to see signs of stabilization in liquidity. We're starting to see new cycle lows for the overnight reverse repo facility, which is good news. And we need the overnight reverse repo facility to be sort of the release valve now that we have QT running still and we don't have liquidity additions from other sources, at least until the fourth quarter, where we know that the Treasury General Account, so the amount of dollars held by the US Treasury at the Federal Reserve, will start to drop due to the debt ceiling deadline upcoming 1st of January. No one will officially tell you that the US Treasury will add liquidity through the fourth quarter. They will officially forecast that they will not add liquidity, but I can guarantee you that they will, because they need to ahead of that debt ceiling deadline. They're not allowed to hold a lot of idle cash, simply due to the fact that they would incentivize politicians to drag out these negotiations for months if they had a lot of idle cash when these negotiations were ongoing. So we've seen the same pattern ahead of debt ceiling deadlines over the past decade.
Which is obviously key to asset allocation and your strategy on that. So Andreas, I just want to touch on inflation before we become, or in a step to become even more actionable here. Yeah. So you mentioned a potential shift in expectations for inflation. Will we see that materialize already in the numbers we're getting this week from the US?
I don't think so, but we'll see that materialize in a few months from now. I think we'll see another soft report this month for the US inflation. But the important thing when you move to the next table here, Mikkel, is to assess whether forward-looking inflation expectations stabilize or not. This is just a simple study on the relationship between the one-year inflation swap in the US. We've posted the ticker in the comments section, so it's basically called US SWIT. And it measures traded expectations. I'm not necessarily of the view that it is a fair reflection of actual expectations. It is very driven by sentiment. It is very driven by balance sheet expectations and so on and so forth. But ultimately, the point here is that there is a very strong relationship between inflation expectations and equities, also to a certain extent crypto, in times of stress. So no matter which equity index you look at on Earth versus this inflation swap, you have a positive C-score, meaning that there is a positive relationship between the two. You need to see stabilization in inflation expectations to buy the dip here.
Very interesting. We'll get back to some heat maps also related to our macro regime models on both on equities and commodities. But before that, Andreas, just to speak even more into the timing of this, is it time to buy again? To reach out for the dip, the evading dip. And I know you have some indicators pointing to perhaps some of the rebound timing, if you could call it that. Should we start with the Texas unemployment here?
So, I mean, I've been stuck in discussions throughout the weekend with a couple of macro economists from the US on whether to expect a rebound in the US labor market here in August compared to what we saw in July. The July job report was abysmal. But the question here is whether it was driven by weather-related layoffs or whether it was an actual increase in unemployment. I think the conclusion is that, at least for the most part of the survey, it wasn't heavily impacted by weather, meaning that the BLS actually kept those temporary layoffs due to weather issues, especially in Texas, but also through the Ohio Basin, etc., out of the calculations for the unemployment rate. But when you look at initial claims, for example, we also saw that last week. We did see a spike in claims due to the storm Beryl through July. Texas is obviously the best example given the impact the storm had in Texas, but we saw similar trends in Louisiana, Indiana, other states, right? So there are some signs of improving trends in, for example, initial claims through August, as these employees impacted by the weather will return to the labor force, basically. So I have a kind of a mixed feeling around labor markets right now. It's pretty evident that unemployment is ticking up. The question is whether you need to be scared of it. We've also had the discussion, Mikkel, whether this could be, I mean, 2 years back in 22, remember we had a couple of quarters in a row with negative GDP growth in the US, but falling unemployment rate at the time. And then people started talking about, well, could this be a recession without any layoffs? Yeah. And now we're basically talking about the opposite, right? Growth, and layoffs without a recession, right now at least. Yeah. There was a release of an academic paper over the weekend trying to add some value to the so-called SAM rule on when to call a recession given what's ongoing in labor markets. I think it's much more likely that we'll get an official recession this time due to the unemployment rate ticking up. I'm just not overly convinced that it matters a whole lot if you're an investor. No. I mean, if unemployment ticks up a percentage point or so, as an investor, who cares? The point here is that there are signs already of an improving business cycle beneath the hood, and unemployment lags the reality in many ways. And therefore, I want to show you this chart on the business cycle, the next one, because what we see right now in various activity gauges in the US is a major gap between the current assessment and the assessment of the future. So the current assessment is super weak, and expectations 6 months forward are strong. That's typically what you see at the very bottom of a business cycle. So I'm not trying to convey a message that we're in a super hot economy right now. I don't think we are. But what we typically see when there's such a gap between the now and the future is that growth rebounds into next year, right? It's a strong sign of investment activity. It's a strong sign of a better future than the current relatively weak state of the present. And the most important thing watching this chart is the lower panel. So when we see such a gap between future expectations and the current assessment, it's typically right at the rock bottom of the equity market. Yeah. So I guess it depends a little bit on whether you're a glass half full, glass half empty kind of guy, whether you see this as a positive or a negative.
Yeah.
I mean, you could also argue that, okay, we have this kind of setup macro-wise, and we haven't sold off in equity markets. Is that an issue? I think there is some merit to that viewpoint. I take the other side of this bet, and I mean, we're at the rock bottom of the business cycle with equity markets doing okay, with inflation still above target, with some signs of momentum in the underlying business cycle.
Liquidity possibly bottoming out.
This is typically your timing to buy, not to sell. So let's see. I mean, at least I find the risk reward of being long much better than the risk reward of being short here after the washout we had of that dollar yen trade. We've covered that extensively over the past couple of weeks.
Yeah, absolutely. Yeah. So just to round this off, I just want to look at some heat maps, just to remind people we're.
I'd like to, Mikkel, let's have a look at this one as well, because
of course,
because it's inflation week, and I know you love the used cars. So I'm basically of the view that we have one, maybe two soft inflation reports left before we see some sort of cyclical reacceleration of inflation due to goods inflation rising. We've had discussions, Mikkel, you and I, on whether to expect both air and shipping freight rates to pass through to consumer prices. Given what's ongoing, and I'll ask you around the negotiations in the Middle East in a second, given what's ongoing in the Middle East right now, it doesn't really seem like we have a solution on the table for the whole shipping malaise in the Red Sea and all that. And we got this interesting indicator out last week, the so-called Mannheim Used Vehicle Value Index. So it's a measure of the auction-based used car prices, and it spiked materially month on month. And that's very out of the ordinary given where we are in the business cycle. And as you can see, we don't have a lot of observations with an increase of, say, 2.6% or so in a month. And this is seasonally adjusted, so it's not something that's driven by seasonality. And due to methodological differences between the CPI and this Mannheim index, it will not show up until roughly September in the consumer price index. But this is one clue that there is some cyclicality brewing beneath the surface in inflation. Mikkel, freight rates, we're still at very elevated levels. We're starting to see the pass through to local both truck and air freight rates in the US and in Europe. But it basically all comes back to the Middle East. And we know that there's been a change of leadership in the Hamas. Basically, they had to pick a new leader after the assassination of Haniyeh. So the new leader of Hamas, is he even willing to negotiate?
He will carry out some level of negotiations, but in my opinion, a true peace deal is still very much a moot point right now. It's not realistic. Basically, both sides are still very eager to fight on, it seems, or at least desperate to fight on, or find themselves in desperate situations. So right now, I think the prospects for peace are very slim. We might see some kind of truce at some point, but I mean, fighting is not nearly as intense as a couple of months months ago, because Hamas has more or less been eradicated from the Gaza Strip and now exists more as a political idea, and that's much harder for Israel to fight. And increasingly, I'm seeing and hearing the Red Sea situation becoming its own crisis or its own situation, a little bit decoupled from the Gaza invasion of the Gaza war. Initially, my assessment was that a peace in Gaza would spill over as peace on the Red Sea situation, but this is less and less the case, and we have to look into a scenario of war in Gaza and attacks on ships in the Red Sea becoming the new normal, and that's very, very hard to get adjusted to. And I think shipping companies are doing some very heavy thinking right now on, if this is the new normal, how do we adjust to that? Do we increase our shipping capacity? What do we do? Can we negotiate with the Houthis? It's still very much up in the air. I think a lot of importers, especially in Europe, have been waiting for this crisis to blow over, to get all their goods in from China. A lot of cargo shipments have been postponed, so we are looking at some significant hiccups and overdue shipments as well. So this is an area of great risk to especially perhaps European consumer prices over the second half of the year.
But the thing here is that global shipping markets, they're interconnected. If the price of freight moves up a lot from Shanghai to Rotterdam, for example, well, you reallocate resources to that route, basically, which in turn increases the price between Shanghai and LA, to take an example. So you cannot see them as separate markets, not over time at least. And we've obviously also seen how we've seen a spike in prices between China and the US, even though that specific shipping route is not directly impacted, so to speak, but it's just indirectly impacted anyway.
Yeah, and one potential effect of this is also that the Chinese producers may also become the selling part in this. Let me just explain that, because websites like Temu, one of the main differences between them and other websites is that they ship or they fly the goods directly from China to primarily European customers. And since the Houthis have yet to begin shooting down cargo planes, that could be the way to go, and that they could win market shares over the goods that are being shipped across the sea south of Africa to Europe. So that's another development we might see. This might not be too bad for China, even though a lot of their exported goods are obviously also been affected by this. So, Andreas, I just want to sum up with some heat maps, as I promised just before here. Just a reminder that this is our macro regime. We've moved the needle to QE-like for August. And I just wanted to present some of these heat maps that we produce out of this as a way of translating this macro regime into an actual asset allocation. So we do this across asset classes. We do this on equities, commodities, fixed income, and FX. I just want to show the equities here. It might be a little bit tough to see. It's much better on our website to look into that. But essentially, the one we've marked here are the QE-like, and then the down scenario, which is relevant if liquidity turns around in this scenario. In the QE-like scenario, seems very, very benign for equities. Essentially, green all over the place.
Maybe except utilities.
Yeah,
right?
except utilities, perhaps.
So that's a conclusion in itself. That I mean, should we get that stabilization in liquidity? Should we get that stabilization of inflation expectations that we expect? Don't price in a lot more rate cuts than what we already have in the forward curve. I don't think that's feasible. Utilities typically perform when bond yields drop. I'm not sure that 10-year bond yields will drop a lot in this kind of scenario for August, which is why utilities, they're not flagged as a major green light. But other than that, yes, you can see information technology is performing well in this kind of scenario. S&P 500 on a broad scale basis is performing well. But I think the most important distinction here, macro regime wise, is in commodities. It's found in commodity space, Mikkel. And admittedly, was it a week ago? I think we spent like 10-15 minutes discussing the gold trade, given I mean, by the time of recording, we haven't even seen a big response from Iran to the Israeli attacks. I've also pondered whether Israel could at some point decide to go against the Houthis. I mean, given that they've attacked right, left, and center around the Middle East lately, I wouldn't rule that out. But my point here is that looking at this gold trade, I mean, it's got a lot of underlying tailwinds. I have to admit that. Geopolitics, lower bond yields, a Federal Reserve cutting cycle commencing in a month from now. So, I mean, some of these typical drivers of gold point in the direction of high gold prices. I perfectly admit to that. It seems very consensual to say so as well. That's one of the things that annoys me. And when you look at positioning right now in gold, it's very, very loaded into longs. When you look at positioning in other metals, we're still talking about a net long position in markets, despite the major sell-off that we've seen in silver and copper, for example, over the course of July. We've earned a truckload of dollars on being short those metals markets. But the gold trade, I've studied correlations between gold and real rates for years. And we've never seen the current regime before. You see gold rising on days where real rates are rising. It's upside down. And I've been thinking on why that is. And my conclusion is essentially that the Chinese gold flows or the Asian gold flows by far outpace the Western gold flows right now. So the most important gauge for gold is whether the dollar increases in value or not versus Asian FX. So when the dollar is strong versus the Japanese yen and the Chinese yuan, you need to buy gold. And the dollar is typically strong versus those currencies in times of rising real rates. And that's completely upside down of the last 10, 15, 20 years in gold. I think the tide has turned on the dollar. The reason why we see a relatively strong dollar right now is that a lot of institutional managers, they have to rebalance their hedging books because of the landslide in dollar equities. So when equities sell off, Japanese life and pension funds, they have to buy back dollars in their FX swaps. When equities sell off, the Chinese and European asset managers also have to buy back dollars. So that's why we see a tick up in the dollar after a really, really poor July. And once the dust settles on this rebalancing flow, the dollar will likely weaken again into this Federal Reserve cutting cycle. And when the dollar weakens versus the Japanese yen, the Chinese yuan, etc., right now, I think the tide turns on the Asian gold flow. And as you can see in the QE-like scenario for commodities, it's not really a strong scenario. It's okay-ish historically for gold and silver, but only okay-ish. While you see Brent, copper, you name it, down the drain in this kind of scenario. And I essentially lean a little bit in that direction on commodities still. So I rather prefer to be long risk assets than commodities, and we still hold some shorts in the metal space.
Very interesting and very actionable as well. That's all we had for you this week. We usually go through some of the numbers coming up throughout the week. I think we covered that throughout the program.
Yeah, so I mean, one major conclusion on this, Mikkel, the PPI is very sensitive to freight rates, input costs, etc. So I think the PPI will look a lot hotter than the CPI. It's essentially what we saw in July as well. We had that spot on, but we didn't have the market moves around it spot on. I have to admit that. So the point here is that when the PPI increases relative to the CPI, you'll get some volatility in the sector rotation in equity space again. But on an ongoing basis, you need to watch liquidity and inflation expectations going forward to really figure out whether there is some merit to this buy the dip narrative right now. We're leaning into risk assets, so we're starting to see green shoots again, I think.
Absolutely. You can check out all our research and all our publications at stenoresearch.com. Until then, have a nice week. We'll see you next Monday. Thanks for this time.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.